In part one, we're given a balance sheet for 2021 and some information what happened during 2022. The balance sheet for 2022 is not complete, but given that we know what happened between 2021 and 2022, we should be able to fill in the gaps. First, we're asked about net income. So let's do that. We know that revenue is 200, and that we can subtract cost of goods sold, and that would give us EBITDA, but we want net income, so we're going to subtract depreciation, we're going to subtract interest expense, and we're also going to subtract taxes to give us net income. Next, cash flow from operations. So we start with net income, and to it we can add non-cash expense, which is a depreciation in this case of $10, but to it, we need to subtract an increase in accounts receivables, because an increase in accounts receivable is a use of cash. The increase in accounts receivable is the end of period accounts receivable minus the beginning of accounts receivable. So that's going to be $2. And so we used $2 worth of cash to finance the accounts receivable. And to that, we can add the increase in accounts payable. Now, accounts payables here didn't change, so it's not going to make any difference, but let's put it in as a formula nonetheless. And that should give us cash flow from operations. What's the cash flow from investing activities? Well, there's only one investing activity, which was an acquisition of property, plant, and equipment worth of $2. Now, acquisition, that's going to be a negative cash flow because that costs money. And cash flow from financing activities. Well, we got some positive cash flow because we issued $20 of new debt. We also issued $10 of new stock, but we paid $5 worth of dividends. So cash flow from financing activities is positive 25. What's the overall change in cash? Well, we could just add up cash flow from these three sources, and we see that change in cash is $33. Fantastic. So now that we know that we can add the beginning of the cash position to the change in cash, which would give us cash position of $43 at the end. We also know what the property, plant, and equipment is going to be. It's going to be the initial one plus the acquisition of $20, but we're going to have to subtract the accumulated depreciation, which is the initial accumulated depreciation plus the 2022 depreciation, which is a total of 20. And so net property, plant, and equipment is $100, a $10 increase. That makes sense because we bought $20 worth of new equipment, but we also had a $10 depreciation. So total assets are 155 in 2022. So we're in a position to calculate return on assets, which would be net income divided by 2022 assets, which is about 13%. Fantastic. Just to make sure that we did things correctly, let's make this a balance sheet balance. Long-term debt, well, we started with 50. But so to do that, we're going to add new debt of 20. That brings us to 70. Common stock, well, we started with 20, but we issued $10 more. Where is that? That's here. So now common stock is 30. Accumulated retained earnings. Well, what are retained earnings? Well, so sure, we started with 10, but in 2022, how much did we retain? Well, we had net income of 20, but we paid $5 of dividends. So I'm gonna add net income, oops, and subtract the dividends of 5, and that brings me to accumulated retained earnings of $25. So that brings us to total equity to 75, total liabilities and shareholder equity of 155. The balance sheet balances, which is excellent. Explain in words what would happen to the balance sheet, cash flow, and return on assets if, as a result of suppliers demanding sooner payment, accounts payable dropped in 2022. So we could, I'm not going to type it on this video, but clearly, if accounts payable drop, if we have to reduce our liabilities, that is a use of cash. So cash balance would drop, total assets would drop, net income is not affected, so return on assets would go up. And since I actually built all the formulas, I can check that. So let's see if this goes down to 5. We can clearly see cash goes down, assets go down, and return on assets would be higher. So in this question, we have an apartment complex with 20 units, painting. Each unit costs $1,000 in operating expenses. Paint lasts 4 years. We could charge additional $300, and we've got 10% required return and tax rate of 20. So let's write a couple of these parameters down. We've got units. There's 20 units. We've got cost. Oops, cost of painting is $1,000. We have additional rent is $300 per unit. Required return is it's 10%, and tax rate is 20%. Okay, so how can we set this up? So we know that we have year 0 where we're going to pay $20,000, and we have year 2, 3, and 4. The easy part is we know the revenue, so additional revenue is well, it's going to be 20 units times 300, and we're going to lock these things in. That's $6,000 per complex. What else do we know? We know additional cost, additional operating cost. Well, there's no operating costs after year 0, but there's operating costs of $20,000 in year 0. And I think that's it on the cost. So we could calculate what is the additional EBIT. So after earnings before interest and taxes, after depreciation, there's no depreciation here. So that would just be the additional revenue minus the additional cost, which of course in year 0 is exactly $20,000, and it's $6,000 after that. Of course, this is going to generate additional taxes, which are at 20%. So let's put that in there. I'm going to lock that formula in. So additional tax, of course, in year 0 is negative, because we're going to save ourselves on our tax bill because we have this additional cost, which is going to reduce our taxable income, and we're going to save $4,000 on taxes. But in other years, we're going to pay an additional $1,200, 20% of it, the additional revenue. So I can calculate what is the cash flow with this project, and it's really just the operating cash flow, which would be the EBIT minus the taxes. So it's a $16,000 negative cash flow that's going to be caused by painting those apartments. It's $20,000 minus the $4,000 in savings, and then in the rest of the time period, it's $4,800. Okay, fantastic. So we could just calculate what is the NPV of this project. We'll take the immediate cash outlay plus NPV at the required rate of 10%. Taking these values gives me NPV of negative $785. What is the IRR? IRR is basically IRR of this stream of cash flows, 8%. Makes sense that it's less than 10% because at the 10%, the NPV is negative. What is the payback period? Well, let's calculate the cumulative cash flow. And that would be, we'll just take the initial cash flow here, and then in the rest of the years, we'll take the previous cumulative cash flow plus that year's cash flow, and copy it all the way down. And we see that at the end of year 3, we still are in the red, negative 1,600. So we know that the payback is going to be at least 3 years plus. Well, into the 4th year, we need to still cover 1,600 negative cumulative cash flow. How long will that take? Well, let's take that 1,600. So I'm going to just use it as an absolute, as an absolute value of 1,600 divided by the 4,800, so I can see how long into year 4 we will need to cover the $1,600 deficit from the end of year 3, and that's 1/3. That's basically a quarter of a year. No, a third of a year. Okay, so 3.33 is the payback period. Fantastic. Now, as an alternative to painting the apartments, we could build a swimming pool, but a swimming pool is a capital expense. It will still allow us to raise rent by $300. The pool lasts only 4 years, is depreciated in a straight line. So this is going to be very similar. So let's actually copy the setup up here. Certainly the first line is the same because we have additional revenue, but now we have some additional cost, which is really the depreciation. So what's the depreciation on this? Is going to be 20,000 divided by 4. So it's really 5,000. That makes sense. How about what else do we have? Well, we do have the CapEx, which is going to be a negative of 20,000 to build the pool. Well, we could calculate EBIT, so earnings before interest and taxes, but after depreciation. So that would be the difference between additional revenue minus additional cost, which is nothing in year 0 because we don't have any additional cost in year 0, no operating costs. We have that capital expenditure, but that doesn't go into earnings. So let's copy this all the way down, and we see that the additional EBIT is $1,000 every year. That's because we get additional revenue of 6,000. We pay additional cost. It's not a cash costs, but it's still a cost that we recognize of $5,000 depreciation, which means an additional profit before taxes is $1,000. So we can calculate what is the additional tax, and that is EBIT times the tax rate, hitting F4 there, and copying it down here. Additional taxes of $200. So now we could calculate what is the operating cash flow as a result of this project, which would be the EBIT minus the tax plus the non-cash expense, which is depreciation. And let's copy that down here. That's going to be 5,800 per year. Does that make sense? Sure, because we get this additional $6,000 in revenue, and we pay additional $200 in taxes. Sure, we have that depreciation cost, but that's not cash outflow. So the cash is coming in years 1 through 4 as $5,800. Now we have CapEx, so we could calculate the total cash flow, because we have not yet taken that into account, and that's going to be basically the capital expenditure plus the operating cash flow, which is 20,000 in year 0 and 5,800 in the years after that. What is the NPV of this project? NPV at, well, actually, let's take the initial negative cash flow plus NPV at 10%. NPV of these 5,800 is going to give us a negative $1,600. So this project has actually even lower NPV than the painting of the apartments. Does that make sense? Well, essentially, the cost of these projects is the same. They all cost $20,000. But with painting of the apartments, the cost is an operating cost. So we get to deduct $20,000 from our taxable income right away in year 0, which is certainly more advantageous than only being able to deduct the cost over time, which is what happens when you make a capital expense. You only get to deduct it from your income over the depreciation of that capital expense, which in the pool, it was over the next 4 years. So because in the painting of the apartment, although we get less money down in the future, we pay less money right up front. And making the pool, building the pool, we pay a lot of money right from the start and then reap the benefits only later. So the NPV and really the comparison is driven by how much we discount the future. If I were to discount future at 0%, then it shouldn't really make a difference when I benefit from deducting the costs. And indeed, if I change the required rate to 0, the NPV is 30 of painting the apartments is 3,200. The NPV of building the pool is also 3,200. So that makes a lot of sense. If I switch back to 10%, And think about the other driver of these benefits of timing of the cost. It has to do with the taxes. If we didn't have taxes, then it again shouldn't matter when we get to take the tax deduction. So let's change the tax to 0, and the NPV of painting the apartments is 981. The NPV of building the pool is 981. So really what drives the comparison is the discount rate and the tax rate. All right, let's go to part 3 of this exam. In part 3, we're given some bonds. Here's bonds issued by Union College. So let's take some of these parameters from their maturity. It looks like it matures in 07/01/2029. When is the settlement? Settlement date is, well, the trade was 31st of January, so 2 days later is 02/02/2022. What else do we know? We know the price is 109.33. We know the coupon rate is 4.15%. Let's make sure that we actually format this as percent. So let's make it 4.15. What else do we need in order to figure out the yield to maturity? Sure, we're going to need a frequency. Frequency is it's a semi-annual bond, and yield to maturity. I think that should be it. So let's go with yield. We need the settlement date. We need the maturity date. We need the coupon rate. We need the price. And we need the redemption. Let's hard code it at 100. Frequency is 2. Basis, let's keep it 0. It's a corporate bond. And the yield to maturity is 2.75, which incidentally is the same thing that we get reported on this information. Suppose the next month the market will require a yield of 3.5. So let's do 3.5 here. Let's make that as a percentage. So 3.5%. And I want to actually make it visible. So it's 3.5%. Let's price this bond. If the yield to maturity is 3.5, we clearly expect the price to go down if interest rate goes up. So let's do price, and the settlement is over here, maturity is over here, the coupon rate is over here, yield is over here, redemption, okay, 100, frequency is 2, timing is 0 is a default. Anyway, 104.21, it drops, price drops when interest rate goes up. Okay, accrued interest. So here, we know that we traded the bond in January, but it matures on the 1st of July. So we have to ask ourselves, that's when the last coupon was, and how many days between each coupon, and how long since the last coupon. So fortunately, Excel contains functions for this, but let's just think about this. This looks like it should be about 30 days since the last coupon, because if the bond matures on July 1st, the last coupon should have occurred about December December 31st, or really January 1st, so about 31 days since the last coupon. So let's see if the function that we have for that actually tell us that. So I'm going to start with coupon days. It's the number of days from the beginning of the coupon day to settlement day. Actually, we'll need that. So let's use that one. Settlement is this one. Maturity is this one. Frequency is 2. Basis, we make it 0. Oh, it's 31, just like we expected. And the number of days between coupons. So this is going to be coupon days. The number of days in the coupon period that contains the settlement date. So that's going to work. Settlement date is here. Maturity is here. Frequency is 2. Basis, make 0. It's the default 180. So the accrued interest is going to be, well, we got $100 face value times the coupon divided by 2 multiplied by the share of days since the last coupon in the total coupon period. And so it's about 36 cents is the accrued interest. Does that make sense? Yeah, it's a pretty small number, right? Because you can only $4 per year. You get $2 every 6 months. So for 1 month, it's only about 36 cents. Okay. Fantastic. So lastly, we're asked to explain why the Princeton bond is so much more expensive. Right? Looking at the trade price of 119 versus the trade price of the Union bond at 109, even though the Princeton bond has a lower coupon rate, substantially lower coupon rate. Now, the big difference between these two bonds is yield, time to maturity. Like how long before they mature. The Union bond matures in, 7 years? The Princeton bond matures in 20 years, 26 years. And so both bonds are selling at a premium. Right? We see that the price is 109 here, and for the Princeton bond, the price is 119. And so both of bonds sell at a premium. Why are they selling at a premium? Because the coupon rate is higher than the interest rate that's applied to value the bond. In fact, the interest rate is actually somewhat lower for the Union bond than for the Princeton bond, but more or less they are equal. So why is the premium so much higher for the Princeton bond than for the Union bond? Well, the answer is that the holders of the Princeton bond are willing to pay more because they're going to get above yield to maturity coupon for a much longer time period. Okay, they're going to be collecting 3.8% coupon for the next 26 years, whereas at Union, even though they're discounted at the same rate, you get to collect a higher coupon. That's true, but only for the next 7 years. So if both bonds had the same maturity date, then the Princeton bond would certainly have a lower price than the Union bond if its coupon rate is lower and the interest rate that we use to price the bond is the same. So we could certainly do this. We could certainly test that calculation, but I'll leave that for homework, and I'm going to stop here.